What is venture debt?
What is venture debt? Right. So, we see a lot of founders creating companies in India, right, which are not even talked about and not even qualified as startups, right? Today, for example, somebody starts a trading firm which is just buying and selling furnitures by putting its own family's capital and running it profitably is also venture, right? But we don't talk about that as a startup. When we call startup, right, there is a framework, as I mentioned, about of risk and reward, right? That you're venturing into an idea which probably has not been done before, but right, but that will only make sense if it scales extremely fast, right? And then because you're scaling it so fast, there's a risk of startup not working out, right? And for you to scale fast, right, one of the most important mode for you is capital, right? Because you're not looking at profitability for next many years, right? The only thing that you're chasing right now is creating the business model, creating the market, and scaling it, right? Then in that case, in early stages, your first backers are typically your friends and family who would essentially put equity investment into your company, which we call as angel investments, right? These are extremely small ticket size investment, which is largely to back the founder and the business idea, right? Once you move forward with that capital and you started kind of creating a product market fit, that's a time of when you spend 1 to 2 years with a startup with limited investment, is when you start talking to institutional investors that, hey, like my idea is coming to life, can I get some more capital to run this business for another 18 to 20 months? Because you have chosen a path where every 18-20 months you will continue to raise capital, because you have chosen a path of disrupting an industry and making it extremely big. And because you're not profitable, you're focusing on growth, every few years you will require capital, and the idea is in 5 to 7 years you are probably on your own or you list your company, right? Then that's where venture capital comes into the play, where your first big capital comes from venture capital equity, where to the founders, every time you're raising capital, you're diluting a part of your ownership, right? But you need capital for 18-20 months. Now the idea is you raise maximum amount of capital at your lowest dilution or lowest cost, right? That is where venture debt comes into the play, where if you raise 100 rupees of, you need 100 rupees of capital, do you need to raise all that 100 rupees as equity? Can you split that up and raise 70 of equity and 30 of debt, right? See, in the most ideal world, founder would not want to raise any equity, right? Founder would want to run the startup profitability on day one, just raise debt capital for your working capital or expansion need and give that capital back to the lender and retain all 100% of your ownership. Because that is not practically possible because of extremely high risk associated with a startup, you need venture capital equity. But along with venture capital equity, can you have an option of taking some debt? That is a solution that venture is trying to solve. Where in early stages, venture is playing a role where it gives you a mix of debt and equity. Over a period of time, debt becomes a lot more important financing option for a company. A company is at a stage जहाँ पर आप profitable हो गए हो, you just need capital for a certain use case, then you probably don't need to raise any equity. See, today in the country, if you look at 90% of the capital being deployed to run the business is still debt, or even globally, right? Beyond a point, like when companies are self-sustainable, equity is once in a lifetime kind of a phenomenon, right? On a daily or a monthly or a yearly basis, all what you play is debt capital. To the startup, it is not possible because you're not able to service all the debt because you're not inherently massively profitable. Hence, you're actually raising equity because you don't get all of it as debt. So actually, the answer is the other way around, where debt anyways is important for any form of company, either for growth capital or financing your certain needs. But because of the very high risk associated, equity becomes a very important base to start up.